Buy when it touches the lower band, sell when it touches the upper band. If that's how you're trading right now, you need to watch this video to the very end, because that approach is wrong. Well, to be precise, it's only half right. And a strategy that's only half right will eventually cost you money in the market. Today, I'm going to show you 3 trading strategies that traders who actually profit use with Bollinger Bands. The third strategy is one that has never been properly introduced before. Stay until the end, and you'll understand why. Part 0 first. Let's address this mistake. Most people use Bollinger Bands like this. When a candle touches the upper band, overbought, so sell. When it touches the lower band, oversold, so buy. That's not entirely wrong. In sideways markets, it actually works. The problem is when a trend forms. When a strong downtrend develops, price doesn't bounce after touching the lower band. It rides the lower band and keeps falling. What happens if you buy at that lower band touch? Bollinger Bands are not a counter-trend indicator. They are an indicator for reading trend and volatility. Understanding this difference is where real trading begins. And one more thing, no matter which strategy you use, always set a stop loss and always honor it. This is not optional. Part 1. Everything you need to know about Bollinger Bands. Bollinger Bands consist of 3 lines. The middle band is the 20-day moving average. The upper band adds 2 standard deviations to the middle, and the lower band subtracts 2 standard deviations. In theory, price moves within this band approximately 95% of the time. However, this figure assumes a normal distribution. The crypto market has frequent sharp moves and fat tail distribution characteristics, so in practice, breakouts can occur more often than the theory suggests. Lower the standard deviation to 1 and the probability drops to 68%. Raise it to 3 and it goes up to 99%. Remember these numbers. They'll come back in the third strategy. Reading the trend is straightforward. If the middle band slopes upward, it's an uptrend. Downward means a downtrend. In an uptrend, the middle band acts as support. In a downtrend, it acts as resistance. Narrowing bands signal consolidation. Widening bands signal a trend in progress. One more thing to add. All 3 strategies introduced today are recommended for use on the 4-hour chart or higher. On shorter time frames, like the 1-minute or 5-minute chart, noise is too high, and signal reliability drops significantly. Strategy 1. The Squeeze Breakout Strategy. The first strategy is the Squeeze Breakout. Start by finding a zone where the Bollinger Bands are contracting, and the middle band is flattening out. It doesn't need to be perfectly horizontal. The upper and lower bands just need to be visibly narrowing. Energy is being compressed in this consolidation zone. At some point, a candle will break out of the bands. That's your entry point. But there's one problem: fake breakouts. Price can look like it's breaking below the lower band, then suddenly reverse and spike upward. If you short it in that moment, you're caught in a losing position. There are 2 ways to filter this out. First, support and resistance zones. When a candle breaks out of the Bollinger Bands, confirm that it also breaks through the nearest support or resistance zone at the same time. Only enter after the candle closes with both conditions met. If only one is met, wait. Second, volume. If the breakout candle is accompanied by a surge in volume, the reliability increases significantly. If that candle's volume is noticeably higher than the recent average, the breakout is likely real. If volume looks normal, be suspicious of a fake breakout. Set your stop loss at the middle band. Set your take profit at 2x the stop loss distance, a 1-2 risk-reward ratio. When the first target is reached, sell half your position to lock in profit. Then move your stop loss to near break-even. When a candle closes on the opposite side of the middle band, exit the remaining position entirely. Cut losses short, let profits run. That's the foundation of breakout trading. Strategy 2. The 1-2-3 Candle Trendline Breakout Strategy. This is the second strategy. It's a bit more refined. Start by identifying 3 specific candles. Candle 1 is the candle that touches the upper Bollinger Band. Candle 2 is the subsequent candle that touches the lower Bollinger Band. Candle 3 is the candle after Candle 2 that touches the middle band and then turns back down. Connect Candle 1 and Candle 3 with a straight line. This becomes your trend line. When a candle breaks above this trend line, enter a long position after the candle closes. Let me clarify one point that often causes confusion. Sometimes, after Candle 2, price drops back to the lower band without touching the middle band first. In that case, the Candle 3 condition is not met. The candle must first touch the middle band before reversing direction. If this condition isn't met, wait. Entering too early is the most common mistake with this strategy. One more point. Candle 1 must be the candle that touched the upper band at the highest point. If multiple candles lightly touched the upper band, designate only the one with the highest high as Candle 1. A clear reference point is essential for drawing an accurate trend line. For short positions, reverse the logic. Candle 1 touches the lower band, Candle 2 touches the upper band, and Candle 3 touches the middle band before turning back up. Enter short after the candle closes below the trend line, connecting Candle 1 and Candle 3. For longs, set the stop loss at the recent low or lower band. For shorts, set it at the upper band. Set take profit at 2x the stop distance, a 1-2 risk-reward ratio. Sell half at the first target, move stop to break even, and exit the remainder when a candle closes on the opposite side of the middle band. Here's why this strategy works in one sentence. When price has tested both the upper and lower bands, then pulls back from the middle band, it means market participants have been exploring direction and are about to commit to one side. The trendline breakout is the moment that decision gets executed. All we have to do is ride that moment. Strategy 3. The standard deviation. 3 extreme breakout. The hidden strategy. Here's the third one. This is the strategy I promised earlier. Remember the standard deviation, 3 figure? In theory, price moves within this range 99% of the time. Put differently, a candle that breaks outside the standard deviation 3 band statistically occurs less than once in 100 candles. It's an extreme outlier. We apply this principle to trading. Add 2 Bollinger Bands to your chart. Set one to the default standard deviation 2 and the other to standard deviation 3. Ignore breakouts of the standard deviation 2 band. When a candle breaks below the standard deviation 3 lower band, enter a long position. Conversely, when a candle breaks above the standard deviation 3 upper band, enter a short position. The logic is simple. Price that has gone beyond where it statistically should be has an overwhelming probability of reverting back. This is the principle of mean reversion. There are specific market conditions where this strategy works especially well. First, immediately after unexpected news or events. When a sudden negative or positive catalyst causes price to spike excessively. Standard deviation 3 breakouts appear frequently. Markets tend to correct overreactions, so reversals in these zones are often swift. Second, right after a sudden volatility explosion. When the bands expand rapidly and a candle briefly breaks through standard deviation 3, the volatility often contracts shortly after, triggering a reversion. On the other hand, there are conditions where this strategy is dangerous. When a strong trend is just beginning. If after breaking standard deviation 3, the candle fails to return inside the band and continues breaking out consecutively, this is not mean reversion. It's a trend explosion signal. Let me walk you through the stop loss and take profit rules. For the stop loss, if price moves an additional 1 to 1.5% beyond the standard deviation 3 band from your entry candle, exit immediately. If price fails to return after the breakout and keeps pushing further, the probability of a trend explosion is high. Cut it fast. For take profit, set the first target at the point where price re-enters the standard deviation 2 band. Sell half there. Exit the remainder when price reaches the middle band. Maintain a minimum risk-reward ratio of 1-2. To summarize, a standard deviation 3 breakout is an opportunity, but only if you can distinguish it from the beginning of a trend. Quick return inside the band after breakout equals reversion. Failure to return and continued breakout equals trend. Distinguishing between these two is the core of this strategy. Today I've walked you through 3 strategies: the squeeze breakout, targeting simultaneous support resistance and band breakouts after volatility contraction; the 1, 2, 3 trendline breakout, building a trend line from 3 candles and waiting for the breakout; and the standard deviation 3 strategy, capitalizing on statistically extreme breakouts. You don't need to use all 3 at once. Deeply understand one, practice it thoroughly, then apply it in live trading. That alone will produce different results than what you're getting now. If you want more chart analysis and trading insights, join our free Telegram channel. The link is in the description. If this video was helpful, please hit the like button, and I'll be back with more actionable content in the next one.